Be it a veteran or a first-time investor, it is common sense that if you're buying a stock, you should obviously buy it at the lowest price possible. Of course, a step before that is identifying a stock worthy of your hard-earned money. But while we know that there are great companies out there, like say a TCS or HDFC Bank amongst others, does a good company necessarily mean a good investment? No doubt, one of the prerequisites of any investment strategy is to buy the stock of a good company. However, a good company may be a bad stock to buy if it is bought at any price. While it may be uber cool for a person to boast of buying a painting or vintage car by outbidding others, you would probably have never come across any individual who will go around beating his chest about buying a stock at its peak. On the contrary, one will often hear investors, YouTubers, financial gurus, and the list goes on, talk about how they were able to identify a winner at rock bottom prices, even if it's a lie. Let's be honest, no one ever wants to admit that they overpaid for anything. All the married men watching this video will agree with this, but we have all at some point hated to admit to our wives that we overpaid for some grocery or similar item. But yet, every investor at some point in their life will surely end up overpaying for a stock. Personally, I have done it more times than I can count, and while I'm hoping that with age I become wiser, in the meantime, there is the next best thing: using a method to actually figure out what a stock is worth. And before you go about saying that I'm just talking through my hat, this method was not created or invented by me. Rather, it is a method prescribed by the American investor Philip Town in his best-selling book, Rule Number 1, The Simple Strategy for Successful Investing in Only 15 Minutes a Week, published in 2006. Ever since I came across this method, I often use it to value stocks, and I like to believe that it has helped me avoid a lot of pain in the markets. But do remember, this is not a trading strategy or a quick tip for making short-term money. The method is strictly for long-term investors looking for good quality stocks at reasonable valuations. So let's dive in to find out more about this method and use it to derive the fair value of a popular Indian stock as an example. In this video, we are going to actually do a live demo of a particular Indian stock, and we're going to figure out what exactly is this method and how, using this method, we can arrive at a fair value. So let's go on. Before we talk about Town's method, let's briefly understand what Town's rule number 1 is about. Rule number 1 is an investment strategy that involves finding high-quality companies trading at a discount to their intrinsic value and then investing in them for the long term. It's based on the idea that the best way to invest is to focus on the fundamentals of a company rather than on short-term market trends or speculation. The strategy involves identifying companies with a competitive advantage that will protect them from competitors over the long term. These companies should have a predictable and consistent business model, strong financials, and a history of increasing earnings over time. Town believes that diversification ruins investors' returns. Hence, what he suggests is that investors identify a few good businesses, analyze them using the simple method of his, and then invest into these companies instead of diversifying unnecessarily in multiple businesses. Now, once these companies are identified, the investor should determine their intrinsic value or the true value of the company based on its financials and potential for growth. If the current market price of the company is below its intrinsic value, the investor should consider buying shares in this company. The idea is that the market will eventually recognize the true value of a company and the stock price will increase accordingly. For the purpose of this exercise, we decided to pick a blue chip company, HDFC Bank, which has over the years proven its mettle. Now I'm going to use my laptop today and I'm going to open an Excel sheet to show you all exactly how we can use this method to calculate the intrinsic value. Now for this strategy, there are 5 inputs required to be calculated, as you can see on my screen here. First is the earning per share for a trailing 12 months period, or in short, what we call the earnings per share TTM or EPS TTM. Then we have the growth rate. Next is the minimum return on investment. And after that, we have the future price to earnings or the future PE. And finally, we have the margin of safety. Now, as we use each input, I'm going to be touching upon each and every one of them. So don't worry about what they mean right now. You will understand it as we work through it together. Okay. So now, as per Town's method, rule 1, we start off by taking the EPS TTM, that's the earnings per share for the trailing 12 months period for HDFC Bank. The earnings per share or EPS is an important financial measure which indicates the profitability of a company. It is calculated by dividing the company's net income with its total number of outstanding shares. So essentially, we need to know how much has HDFC Bank earned over the last 12 months per share. Now, we can get that information from any credible financial website. Now, I'm going to open the Equitymaster stock screener website here, which I used to find out such details. And here I'm going to enter HDFC Bank. And then when we come down here, we scroll down here, we can see that the earnings per share is at 78.84. So let me enter that into our Excel sheet first, right here. So that's our first input that I've put in. Next is the tricky part. We need to enter the growth rate that's expected of HDFC Bank for the next few years. Now, as per Town, what he says is that you can either use the past 10 years equity growth rate or use current analyst estimates, whichever is lower. Now, as an investor, one can always modify such inputs as what may make sense to one investor might not to another, or one could be more bullish on prospects of a particular company or sector as compared to another investor. So considering that this is a variable that requires some kind of prediction, I like to use a slightly modified version of it. First, I use the historical data to calculate the rate that the company has grown over the last 10 years. Next, I try and find the company's earnings call transcripts or interviews of the top honchos of the company to determine if the management has provided some kind of guidance for the next few quarters or years ahead. And finally, I also look up estimates provided by analysts, although I don't particularly place too much importance to it. Rather, I use it as an additional step to check if there is a very big variance between their estimates and my calculations. So for our example of HDFC Bank, let's start with the first step here, which is using the historical equity growth rate, which on a per share basis is the book value per share. Now again, this sort of information you can get from the company's financials or again any financial website. Here on Equitymaster, if I go down here to the 5-year fact sheet, I can look here, and here we have the book value per share right here. But this is for 5 years. Now, I had already found this data and kept it ready for the purpose of this video. So here I have the book value per share for the last 10 years for HDFC Bank, which is all put in here. Now what we're going to do is simply calculate the yearly growth in book values. So for this, I'm going to enter a simple formula here in this cell D30, which is simply D29 divided by C29 minus 1. This gives me the growth rate between the year 2013 and 2014. So now I'm going to take this formula, and I'm going to just copy it across all these cells. So here I get the growth rate across the years in HDFC Bank's book value. Now what I need to do next is average this. So I'm going to simply use this average formula here, and I'm going to average this out for this period. Now if you can see, the figure that I get is 15.4% as the average book value. Now for anyone who has been tracking HDFC Bank, it is a well-known fact that the company has been able to grow consistently over the years to become India's largest private sector bank by assets. In fact, if one was to go back and see between 2000 and 2010, the bank used to grow at a CAGR of 25%, which over the years has reduced to around 15 to 18% as the bank has become bigger and bigger. This is normal for any company, as the phenomenon is called the law of large numbers. However, in an interview last year, Sashidhar Jagdishan, who is the CEO of HDFC Bank, had mentioned that he expects a growth rate of 18 to 20% and profits to double to $15 billion in the next 5 years after the merger with HDFC Limited. Now, if one was to look at analyst estimates, it is in line with the above. The average growth estimate by analysts for the next 5 years is 19.9%. But while the merger may bring in many positives for the bank, let's be conservative as always and assume that as an even larger entity post the merger, the growth could possibly moderate going forward. Hence, instead of the historical average of 15.4% and the management and analyst estimates of 18 to 20%, I'm going to assume a growth rate of say 13% for this calculation, just to be on the safe side. So what I'm going to do here in my sheet is I'm going to enter 13% as the growth rate. Now one thing to note here is that this method of valuation would work only for stable companies with a strong track record of growth and profitability. This would not be the right way to value a cyclical stock or a high growth business, as there is a calculated assumption being made and hence there is room for error. Moving on, the next step in the method is entering a minimum rate of return. Town suggests that we use 15%. Currently, debt investments such as AAA rated fixed deposits generate an assured return of 7.5% to 9% per annum. Hence, as an equity investor, if one is taking a risk with his or her capital, a minimum return of 15% would seem reasonable. So we are going to use the same rate as prescribed by Town, which is 15% as a minimum rate of return, and I'm going to enter it here in my sheet. The next input for our calculation is the future PE ratio. Now for this, Town suggests two methods. The first is that investors simply double the future growth rate that we got earlier, which is 13%, or one can use the 5-year average PE that the company has had in the last 5 years. Now if I was to double the growth rate of 13% that we estimated earlier, we would have a future PE of 26. On the other hand, if we were to go back to the Equitymaster website and look at the historical PE ratios of HDFC Bank, which are here, then we can see that the average of these 5 years works out to 22.7. Again, being a conservative investor, I'm going to take the lower number, which is 22.7 and not 26 as the future PE for our calculation. So here I add 22.7 in our sheet for the future PE. The final input used to calculate the fair value of a stock using this method is what Phil Town calls the margin of safety. Warren Buffett once said the 3 most important words in investing are margin of safety. What it simply means is always pay less than the actual value of something. The margin of safety is the discount rate that you can buy a good business at as an investor. Town suggests that we use 50% of the fair value of the company's share price once we derive it. So in our case, we are going to stick to 50% as the margin of safety for HDFC Bank and enter this as well in our Excel sheet. Hence, once we work out the fair price of the stock, we are going to discount it by 50% so that it offers us great protection in case of a downside. Simply because it means we would be buying something that we think is worth rupees 100 for just rupees 50. And on the other hand, when prices move higher, our return on investment would be much greater as we would have purchased the stock at half of its intrinsic value. Alright, so now that we have all the inputs, let's derive the fair value for HDFC Bank at which investors could consider the stock. Now the first step to calculate the value is forecasting the EPS for the next 10 years. Now we have the current figure 78.8 as EPS. Now assuming our growth rate of 13%, let's see how the EPS grows over the next 10 years. For this, first let's enter our most recent EPS figure, which is 78.8 here in cell C37. Next, I use this formula, which is C37 plus C37 into the growth rate which we had calculated, which is C4. And I'm going to just so here you have it. Now we have the EPS for 2024 as well. Like this, I'm going to copy this across the cells, and with this, if HDFC Bank continues to grow at 13% per annum, then the EPS would have grown from 78.8 in 2023 to 236.7 rupees in 2032. So with this future EPS figure, we can now plug in the future PE number, which is 22.7 according to our table right here. So if HDFC Bank has an EPS of 236.7 in the year 2032 and the market is willing to pay a PE of 22.7, it simply means that investors are ready to pay 22.7 times for every rupee earned by HDFC Bank. Hence, as per this logic, let's see what should be the share price of HDFC Bank in 2032. Here in cell L38, I'm going to simply multiply this figure 236.7 by the future PE that we had calculated earlier. This gives me a price of rupees 5,373, which should be the price of HDFC Bank in 2032. Now that we've figured out the future value of HDFC Bank, we can calculate backwards to find out what is the right price to pay for the stock currently. For this, we use our input, the minimum return on investment, or the ROI. Now, as per the table, we had decided on a minimum ROI of 15%, which means that if I invest in any stock, or in this case HDFC Bank, I need to make a minimum ROI of 15% per annum. Hence, calculating backward, I will reduce the future share price of HDFC Bank, which is 5,373 rupees, by 15% every year all the way back to the present year. So how do I do this? Simple. I will use this formula in K38, which is taking simply the price that I got in 2032, L38, and I'll divide it by the minimum rate of investment which we had discussed. Doing this, if I take this and drag it all the way back to the present year, I arrive at a fair value of 1,527 rupees per share of HDFC Bank as on today, as against the current market price of 1,684 rupees at which the share is traded as of today. Hence, using this method, HDFC Bank is currently overvalued by about 10%. However, there is still one last step to Towns' rule, which is the margin of safety. Now, as a value investor, one would want to purchase stocks at a discount to the fair price. So, using the 50% margin, I simply slice off 50% of our price of 1,527 here to arrive at a figure of 763 rupees per share, which according to this method is the best price to buy HDFC Bank shares at. This means that at the rate of 763 rupees, the stock could be extremely attractive with very limited downside risk and a huge potential for significant return on investment. Again, this can be modified as per an investor's view on a particular sector or stock. For instance, I may be comfortable with only a 25% margin of safety, meaning I could be very interested in the stock at levels of 1145 rupees. There you have it. Now you too can find the fair price of any stock using the Rule 1 method. Overall, the Rule 1 strategy emphasizes the importance of patience, discipline, and a focus on the long term. It requires careful research and analysis of companies and their financials, as well as a willingness to wait for the right investment opportunities to come along. Philtown's Rule 1 investment strategy is only one of many such methods to value a stock and find a potential winner. Most importantly, keep in mind that when using any of these methods, we have to make certain assumptions which may go horribly wrong, because this is not an exact science. While the Rule 1 strategy has its advantages, there are also some potential flaws to consider. One of the key components of the Rule 1 strategy is determining a company's intrinsic value. However, this can be a challenging task as it requires making assumptions about the company's future earnings and growth potential. If the intrinsic value estimate is incorrect, it could lead to overpaying for a stock, resulting in lower returns or even losses. Further, this approach can be challenging for investors who may not have the time or expertise to conduct thorough research on individual companies. Finally, the strategy assumes that the market will eventually recognize the true value of a company, but this may not always be the case. Market volatility and unpredictable events can impact stock prices and company valuations, which could lead to unexpected losses. As always, it's crucial to conduct your due diligence before making any investment decisions. Despite the favorable outlook, don't overlook the significance of sustained research. Investing your hard-earned money should not be taken lightly, so make sure to conduct thorough research before making any commitments. If you would like to see more of such valuation videos, please write in the comments and share your views. Hope you enjoyed this video. Thank you so much for watching. Goodbye.
Thank you for tuning into Equitymaster's YouTube channel. If you enjoyed this video, we've got many more valuable investing ideas for you. Click the link in the description to access them now.